What you're about to hear demands your complete attention. This isn't speculation, theoretical analysis, or just another financial market update. 10 days ago, on February 5th at 2:47 in the afternoon Eastern Time, something extraordinary happened in the overnight repo market that created ripples across institutional trading desks from New York to London to Tokyo. The repo rates, essentially what banks pay to borrow overnight cash using Treasury securities as their safety net, suddenly exploded. They leaped from their comfortable range of 4.5% to 4.8% and shot up to 9.2% within just a few hours. Let that sink in for a moment. This wasn't your typical market crash or the kind of panic we're used to seeing. What we witnessed was far more insidious. The fundamental plumbing that keeps the entire global financial system running smoothly started to malfunction. What makes this situation distinctly different from every market hiccup over the past 5 years is that the Federal Reserve's emergency backstop facilities, those same mechanisms that prevented complete financial collapse in March 2020 and stepped in again during the Silicon Valley Bank disaster in March 2023, were tapped by 14 separate institutions in just one trading session. 14 institutions all desperate for emergency liquidity on the same day. You won't find this number splashed across Bloomberg terminals or CNBC chyrons because it's buried deep in the Federal Reserve Bank of New York's operational data that only surfaces after a 48-hour delay. But make no mistake, the institutions themselves know. The trading desks are fully aware, and the sophisticated money is already repositioning their portfolios. The repo market represents a staggering $4.6 trillion overnight lending ecosystem that operates completely under the radar for most people. Yet it serves as the absolute bedrock of how banks, hedge funds, and massive institutional investors manage their immediate cash requirements. When this market suddenly freezes up, when the price of overnight liquidity jumps by 200% in a single afternoon session, there's only one interpretation. Major financial players are scrambling desperately for cash, and they're willing to pay virtually any interest rate to secure it. Over the coming minutes, I'm going to unpack exactly what went down on February 5th, explain why this represents a fundamental structural break rather than a temporary market dislocation, show how this connects directly to the $6.8 trillion in Treasury securities currently sitting on bank balance sheets, showing massive unrealized losses, and most importantly, reveal the 3 asymmetric strategic moves you need to understand immediately to safeguard your wealth and position yourself advantageously for what's coming next. This conversation isn't about spreading fear or panic. It's about recognizing patterns, preparing intelligently, and understanding that what transpired in the repo market just days ago mirrors the same warning signals we observed 90 days before Lehman Brothers imploded in 2008 and 60 days before the European sovereign debt crisis spiraled out of control in 2011. By the time you finish reading this analysis, you'll grasp more about systemic liquidity risk than 99% of retail investors out there, and you'll walk away with a concrete action plan. So eliminate the distractions, and let's break this down methodically, because time is not on our side. Before dissecting the mechanics of what happened on February 5th, you need to understand the fundamental framework that governs every major liquidity crisis in modern financial history. I refer to this as the liquidity cascade model, and it's built on a principle that most investors completely overlook until it's far too late. Financial markets don't operate purely on fundamentals. They run on 3 critical variables: the availability of cash, how quickly that cash moves through the system, and the willingness of counterparties to extend loans to each other. When even one of these 3 variables breaks down, the entire system can seize up within hours, completely independent of the underlying economic fundamentals. The repo market sits at the absolute center of this puzzle. Repo is shorthand for repurchase agreement, and here's how it functions in the most straightforward terms. A bank or hedge fund holds Treasury securities on its balance sheet, let's say $100 million worth of 10-year Treasuries, but they need immediate cash today to meet margin calls, fund new trades, or settle existing obligations. They enter the repo market and sell those Treasuries to another institution, typically a money market fund or another bank, with a binding agreement to repurchase them the next day at a marginally higher price. That price differential is the repo rate, which effectively functions as an overnight interest rate on a collateralized loan. When the system operates normally, repo rates track incredibly closely with the Federal Reserve's benchmark policy rate, currently hovering around 4.5%. Banks can borrow overnight at that rate, give or take a few basis points, and the financial world continues spinning smoothly. But when repo rates suddenly spike, when they unexpectedly jump to 7%, 8%, 9%, or even higher, it sends an unmistakable signal. Lenders are either running critically low on available cash to lend, or they've lost confidence in the collateral being offered. And remember, in a treasury-backed repo market, that collateral is theoretically supposed to be completely risk-free. So when rates exploded the way they did on February 5th, the message couldn't be clearer. The system is experiencing serious stress and institutions are hoarding cash rather than lending it out. This exact pattern appeared in September 2019 when repo rates rocketed to 10% overnight, forcing the Federal Reserve to intervene with hundreds of billions in emergency liquidity injections. We saw the identical pattern in March 2020 when the COVID crisis struck and repo markets froze entirely, requiring the Fed to pump over $1 trillion into the system within days, and we witnessed it again in March 2023 when Silicon Valley Bank and Signature Bank collapsed, leaving regional banks suddenly unable to access overnight funding. The fundamental thesis here is straightforward. We're witnessing the opening stages of a liquidity crisis driven by a toxic combination of massive unrealized losses sitting on bank balance sheets, rising treasury yields that are systematically destroying bond portfolios, and a Federal Reserve trapped between its mandate to fight inflation and its responsibility to prevent a complete financial system collapse. This liquidity stress is creating three asymmetric opportunities: in short-duration cash equivalent positions, in precious metals as zero counterparty risk assets, and in deeply distressed financial sector trades for those with the risk tolerance and timing ability to catch the bottom. Understanding this framework allows you to position yourself ahead of the crowd. Now let's examine the historical precedents, because the pattern we're observing today has played out twice before in the last century with devastating consequences for those who failed to recognize the warning signs. The first parallel takes us back to the liquidity crisis of 1931, often overshadowed by the more famous 1929 stock market crash, but actually far more destructive to real wealth. By 1931, the stock market had already declined significantly, but the banking system remained largely intact. Then, in May of that year, Austria's largest bank, Creditanstalt, suddenly collapsed due to a liquidity crisis. Despite having theoretically sound long-term assets, it couldn't meet its short-term obligations. This triggered a catastrophic cascade across Europe. German banks faced runs, British banks faced runs, and within months, over 2,000 banks across the United States had failed. The common thread was liquidity. These institutions held valuable assets, but they couldn't convert those assets into cash quickly enough to meet withdrawals and obligations. The repo market didn't exist in its modern form back then, but the overnight lending market between banks functioned identically, and when that market froze, when banks stopped lending to each other out of pure fear, the entire system collapsed. The investors who preserved their wealth during this period were those who recognized the liquidity warning signs early. They withdrew deposits exceeding insured limits from banks, converted paper assets into gold, which was still legal to own at that time, and held cash only in the safest possible institutions. The critical lesson from 1931 is that liquidity crises move far faster than solvency crises. By the time a bank is officially declared insolvent, the liquidity crisis has already obliterated wealth across the entire system. The second historical parallel is the 2008 financial crisis, specifically the Lehman Brothers collapse. Most people remember Lehman as a bankruptcy caused by toxic mortgage-backed securities, and that's partially accurate, but the actual mechanism of death was a repo market freeze. Throughout the summer of 2008, Lehman continued operating normally. It held assets, generated revenue, but relied completely on the repo market to fund its daily operations, borrowing tens of billions overnight using its securities as collateral. In early September 2008, repo lenders started pulling back. They demanded higher haircuts, meaning they would lend less money against the same collateral. Then they demanded higher interest rates. Finally, they stopped lending altogether. On September 15, 2008, Lehman Brothers filed for bankruptcy, not because its assets were worthless, but because it couldn't access the cash it needed to open for business that morning. The repo market had completely frozen. Once Lehman fell, contagion spread instantaneously. Money market funds broke the buck, commercial paper markets seized up entirely, and the whole global financial system came within hours of complete shutdown. The Federal Reserve and Treasury were forced to inject trillions in emergency liquidity through TARP, the discount window, repo facilities, and direct bailouts to prevent total collapse. The investors who spotted the repo market stress during summer 2008 and repositioned into cash, gold, and out of financial sector stocks were the ones who avoided the worst carnage. Those who ignored the warning signals and remained fully invested watched their portfolios get sliced in half. Here's what connects those two historical periods to our current moment. Both were preceded by extended periods of asset price inflation funded by cheap and abundant credit. Both saw leverage build up across the financial system to completely unsustainable levels. Both experienced an initial shock that exposed that leverage. And both saw the repo market and overnight lending markets freeze as the primary mechanism of contagion. We're now in the early stages of that identical pattern. But the trigger this time isn't subprime mortgages or European sovereign debt. It's the $6.8 trillion in unrealized losses sitting on the balance sheets of U.S. banks due to rising interest rates over the past several years. Let me explain how this mechanism works, because this is the quiet process that makes the February 5th repo spike so genuinely dangerous. When a bank purchases a treasury bond or mortgage-backed security, it books that asset at par value on its balance sheet. If the bank buys a 10-year treasury bond yielding 2% and holds it until maturity, everything works perfectly fine. But if interest rates rise substantially, the market value of that bond falls dramatically. A 10-year treasury yielding 2% becomes worth significantly less in a market where newly issued 10-year treasuries are yielding 5%. The bank hasn't technically lost money yet because it intends to hold the bond to maturity. But if the bank suddenly needs to sell that bond to raise immediate cash, it must sell at the current market price, which means taking a realized loss. According to the Federal Deposit Insurance Corporation's most recent data, U.S. banks are collectively sitting on approximately $6.8 trillion in securities, and a substantial portion of those holdings are underwater due to the aggressive interest rate increases from 2022 through 2025. This isn't secret information, it's disclosed in regulatory filings, but it doesn't become a problem until it suddenly becomes a massive problem. And it becomes a problem when banks need liquidity fast. Now let's connect this directly to what happened on February 5th. According to the Federal Reserve Bank of New York's repo operations data, published with that 48-hour delay, the overnight repo rate exploded from its normal 4.5% to 4.8% range up to 9.2% during the afternoon trading session. Simultaneously, the Federal Reserve's standing repo facility, an emergency backstop for banks that cannot access funding in the private market, saw usage from 14 institutions in a single day. That represents the highest number of institutions accessing that facility since March 2023 during the regional banking crisis. The Federal Reserve hasn't disclosed which specific institutions tapped the facility. That information remains confidential to prevent market panic. But we can reasonably infer from the repo rate spike and transaction volumes that several large institutions were desperately scrambling for cash. Why would institutions be scrambling for cash? There are three possible explanations, and all three are deeply concerning. The first explanation, a major institution or multiple institutions are facing substantial margin calls or client redemptions that require immediate liquidity, and they can't sell their treasury or mortgage-backed security holdings without taking massive realized losses. So instead, they're borrowing in the repo market at whatever rate they can get. The second explanation, counterparties in the repo market are pulling back because they're genuinely worried about the creditworthiness of borrowers. Even though repo loans are collateralized by treasuries, if the borrower defaults, the lender must sell the collateral in a potentially falling market, which could result in a loss. So lenders are demanding substantially higher rates to compensate for that risk. The third explanation, and this is the most systemically dangerous, is that there's an overall shortage of cash in the system. The Federal Reserve has been running quantitative tightening, meaning it's been actively shrinking its balance sheet and pulling liquidity out of the financial system. Simultaneously, the Treasury has been issuing massive amounts of new debt to fund enormous deficits, which absorbs available cash from the financial system. If the supply of cash is shrinking, while demand for cash is rising, repo rates spike dramatically. All three of these explanations point to the same conclusion. The financial system is under serious liquidity stress, and that stress is accelerating rapidly. Now let's discuss the second-order effects, because a repo market seizure doesn't remain contained in the overnight lending market. It spreads throughout the entire economy. When banks can't access cheap overnight funding, they immediately pull back on lending. They tighten credit standards dramatically. They reduce or eliminate lines of credit to businesses and consumers. This is precisely how a liquidity crisis in the obscure repo market translates into a credit crunch in the real economy that affects everyday Americans. We're already seeing early warning signs. Commercial and industrial loan growth at U.S. banks has decelerated to nearly zero on a year-over-year basis, according to Federal Reserve H8 data. Credit card charge-off rates are climbing, auto loan delinquencies are rising, and commercial real estate lending, which we've covered extensively in previous analyses, is effectively frozen solid. Now layer on top of this the reality that the Treasury is still issuing over $2 trillion in new debt annually to fund massive federal deficits. That debt must be absorbed by the market, and if the market is facing a liquidity crunch, yields must rise to attract buyers. But rising yields make the unrealized losses on bank balance sheets even worse, which creates additional liquidity stress, which forces more repo borrowing, which spikes repo rates even higher. This is a vicious feedback loop, and once it begins accelerating, it becomes extremely difficult to stop without massive central bank intervention. So, what are the three asymmetric plays in this environment? Let me be crystal clear about this, because positioning during a liquidity crisis differs fundamentally from positioning during a solvency crisis. The first play is cash and cash equivalents in the safest possible vehicles. I'm talking specifically about treasury bills with maturities under 90 days, money market funds that invest exclusively in government securities, and FDIC-insured bank accounts that remain well below the $250,000 insurance limit. The reason this positioning is asymmetric is because during a liquidity crisis, cash truly is king. When everyone is desperately scrambling for liquidity, the people holding cash can purchase distressed assets at pennies on the dollar. This is precisely how sophisticated money made fortunes in 2008 and 2009. They held cash through the crisis, then deployed it aggressively when assets were being liquidated at fire sale prices. The key principle is avoiding duration risk. Do not hold long-term bonds or bond funds right now, because if yields continue rising, those positions will get absolutely crushed. Stay short, stay liquid, and stay safe. The second play is physical gold and silver as a zero counterparty risk hedge. In a liquidity crisis, the weakest link is always counterparty risk. Your bank deposit represents a liability on the bank's balance sheet. Your bond is a promise from the issuer. Your brokerage account is a claim on securities held by a custodian. All of these involve counterparty risk. Physical precious metals have zero counterparty risk. When you hold physical gold or silver, you own final settlement. There's no intermediary, no institution that can freeze your account or fail and take your assets with it. Historically, gold performs extraordinarily well during liquidity crises. In September 2008, after Lehman collapsed, gold initially fell as institutions liquidated everything to raise cash, but within 3 months, it was making new highs as investors fled into safe haven assets. In March 2020, the identical pattern played out. Gold dipped briefly during the liquidity scramble, then rallied over 40% in the following months. The strategic move here is allocating a meaningful portion of your portfolio, at minimum 10% to 15%, into physical gold and silver that you hold outside the banking system. Not ETFs, not futures contracts, not unallocated accounts. Physical metal in your possession or in fully allocated segregated storage. The third play, and this is exclusively for those with higher risk tolerance and the ability to time entries precisely, is distressed financial sector equities and credit. When a liquidity crisis hits, financial stocks get absolutely destroyed. Banks, broker-dealers, asset managers, insurance companies, they all sell off indiscriminately. But not all financial institutions are created equal. Some have fortress balance sheets, low leverage, and strong liquidity positions. These institutions will survive the crisis and will temporarily trade at Depression-era valuations during the panic. This is the exact playbook that made Warren Buffett billions in 2008 and 2009, when he bought Goldman Sachs and Bank of America preferred shares at deeply distressed prices. The asymmetry is that you're buying high-quality institutions at prices that assume bankruptcy, but the reality is they will survive and ultimately thrive once the liquidity crisis passes. The key is patience. Wait for the panic. Don't try to catch a falling knife. Wait until repo rates have spiked even further, until we see forced liquidations, until the Federal Reserve steps in with emergency measures. Then you deploy capital into the highest quality names at the lowest prices. Now let's discuss the forward-looking indicators you need to be monitoring closely, because this situation is evolving in real time. The first indicator is the Federal Reserve's standing repo facility usage, reported with that 48-hour delay on the New York Fed's website. If we see usage continue climbing above 10 institutions per day, that tells us the stress isn't subsiding, it's intensifying. The second indicator is the SOFR spread, the secured overnight financing rate compared to the Federal Reserve's target rate. SOFR serves as the benchmark for repo transactions. If the spread between SOFR and the Fed's target rate continues widening, that's a clear sign that the private repo market is under sustained stress. The third indicator is Treasury bill yields at the very short end of the curve, specifically the 1-month and 3-month T-bills. If those yields start spiking relative to longer maturities, it signals that institutions are desperate for short-term cash and willing to pay premium rates for it. The fourth indicator is credit default swap spreads on major banks. CDS spreads measure the cost of insuring against a bank default. If those spreads start widening significantly, it means the market is pricing in substantially higher default risk, which will exacerbate the liquidity crisis. Here's the critical question. Do you believe the Federal Reserve will step in with emergency liquidity measures within the next 30 days? Or do you think they'll let this situation play out to keep fighting inflation, even if it means something breaks in the financial system? The debate raging in the macro community right now is intense. Some analysts believe the Fed will pivot at the first sign of genuine systemic stress. Others believe they've learned lessons from the mistakes of 2008 and 2020, and they're willing to let institutions fail if it means restoring credibility to monetary policy. And here's the final critical point. If you found this breakdown valuable, if you recognize that what we just covered isn't being discussed on CNBC, Bloomberg, or any mainstream outlet because it's too technical and frankly too frightening, then you need to understand the gravity of this moment. The repo market seized on February 5th. Wall Street is panicking quietly behind closed doors. The emergency liquidity facilities are being accessed at levels we haven't witnessed since the last crisis. And your portfolio positioning over the next 30 days will determine whether you emerge from this situation ahead or whether you become part of the collateral damage. This isn't about fear or panic. This is about intelligent preparation, pattern recognition, and making informed decisions with your wealth. The liquidity cascade has already started. The only question remaining is whether you're properly positioned for what comes next.